Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for September 5th of 2022. Please see our disclaimer for important information. Well, as we start the chart pack this week, I want to go back and revisit the labor market briefly here and talk about participation rates. And what we're seeing is that some of the older age cohorts getting back into the labor market. We saw some of those folks exit during the pandemic. You can see here a trend line that goes back to about 2007, and we had several years of declining participation, and then we started to see that reverse itself, and then the pandemic hit, and we had a huge dislocation. But we're almost back to pre-pandemic levels, which if you look at it on its face, if you're bringing more people into the labor market, where you have a situation where you've got about 1.6 jobs available for every unemployed worker. If you bring more people in, that is inherently disinflationary. And so if you're considering the pace of inflation and the expectation that inflation is going to come down, this would certainly help having greater participation in the labor market. Here's a quick look at container shipping rates. And we know the cost of freight was extraordinarily high last year. That had a lot to do with some of the shutdowns in China, supply chain issues, which bottlenecked a lot of different areas of the shipping industry. But just speaking for container freight, we know at one point, as you can see here, it was up 200%, and these are freight rates from Shanghai to LA. And now, on a year-over-year basis, they're up roughly about 34%. So it's still up in aggregate terms, a meaningful amount year over year, but not necessarily the kind of issues that we saw a year ago. Here's operating margins for the S&P 500. So we do have the benefit of all of the second quarter data now, of course, and in about another month and a half, we're going to begin to get information on third quarter results. But as we look here, we can see that margins, which we knew were inherently too high, were apt to come down, and indeed they have. So if you go back to March of 2000 and run that straight line trend line, you can see in the middle of this chart, average margins about 8.5%. Of course, they're influenced by kind of the tail factors, right? So the 2008 global financial crisis was certainly an impact there. But if you look over time, that generally speaking, you didn't see too many data points that kind of were below that. Obviously, in 2012, then again in roughly the end of 2015, we saw it go below the trend line, but we've been at astronomical levels lately. And again, like I said, we knew that those were unsustainable. Cost pressures, I think, in the inability for producers to send those along through the production channel into the final user or essentially the final buyer. The cost inputs were, in some cases, have been going up faster than their ability to raise prices. And obviously, if you're in a competitive market space, you're less reluctant to want to do that because, for the fear of ceding share to your competitors. And now I'm going to go ahead and transition into the housing market for a few slides. Some really interesting data coming out of Charlie Bolello here lately. I have shown you this slide before, but it's helpful to kind of remind ourselves how important the housing sector is to our overall economy. And on this particular slide, we're looking at the supply of new single-family houses. And you'll see in a few slides coming up where we have we're still underbuilding relative to our population and new household formation growth. And here, this chart tells us that anytime you have a month supply of new home inventory above 10 months, that it typically correlates with recession. So not sure that this should be any shock to anybody that we're probably heading towards a recession, but it's interesting to watch this correlation here. And certainly this is not a conversation we would have had over a year ago when inventory was extremely tight. And so now I think we can all We all know, and looking at our own neighborhoods, that there are for sale signs on homes that have been on the market for a little while now, and the housing market is really kind of normalizing. And I wouldn't call 10 months of new home supply normal necessarily, but at least we'll look at price data here in a moment. We'll look at some other things that are really indicative of this housing market slowing down, and I think a lot of it has to do with affordability, with mortgage rates being higher. It has a lot to do, with new home construction, slowing down. Builders are less optimistic as we kind of foreshadow a recession. But we'll take a look at a couple of these charts coming up, and I think it'll kind of build a healthy expectation base for all of us for the housing sector. Now we look at sale prices here in this particular chart. We know the median sales price is down about 6% from its June all-time high. And you can kind of see that here in that red for 2022. You can see where it crests rather significantly relative to the last 2 years. And we can see that that trend line has gone up each of the last 2 years. But we do see this deceleration. And so even with this decline from the peak, we're still up about 6% year over year. And here's an interesting chart from Redfin, which I thought I'd share. This shows us that the average home actually sold in August for slightly less than list price. And that has obviously not been the case, as you see here in 2021, as well as 2022, particularly in kind of these peak months, if you will, kind of like, the end of school year into summer where people typically move. I mean, last year, or even several months ago, those numbers were extraordinarily high, and you do see those coming down. So again, more evidence of this market kind of slowing down a little bit. And then, but even still, you do see U.S. home prices on a national basis up 18% year over year, and they're still up 40% over the last 2 years. Here's a quick look at rent. This is U.S., this is a national average of rent. And if you go back and you look at this trend line, and obviously rents are continuing to move up, and we knew they would in response to home price increases. And as I mentioned, we've had over the last 2 years in a lot of major markets, we've had almost 40% increase in home prices. Here, we do see a deceleration, though. If you look back relative to this rate of change, we're up about 10% year over year in rents, which obviously falls below the rate of home price appreciation, but it is the slowest rate that we've seen since last June. So we do see rent increases moderating a little bit. So in continuing to talk about residential real estate here, we do have on the left-hand side a ratio of mortgage payment to asking rent. And so this is a kind of a relative affordability type measure that we look at. So obviously we know that mortgage payments themselves have gone up, one, because home prices are moving higher. And so the basis on which mortgage payments are calculated is going up, as well as the interest rate. And those are two very important factors. So mortgage payments relative to rent, and we just saw that the rate of rent increase was kind of moderating a little bit, and certainly lagging new home price appreciation. And so as a result, we see this ratio here on the left-hand side moving up closer to about 1.5, which, as you can see, going back into the global financial crisis, was really the last time that we saw this ratio this far out of whack. Now on the right-hand side, we've got month-over-month change in national rent. You can see where 2021, 2022, we really began to have that catch up. And again, these are kind of raw numbers compilated by apartment list, national data collector here. And so, before the last couple of years, those increases were on the order of, 0.5 to 1%, on a month over month basis. So far more benign than we've seen here lately, but, which has been in the order of like, 1.5 to almost 3%. on the upper right-hand side, and then in the lower right-hand side, you can see the annual change in median levels of rent. And you look at 2021, it was up over 17%. So there was a lot of catch up with all of the home price appreciation that really started in 2020. And then here you see in 2022 where that has slowed up a little bit. So the next question when we're talking about home prices in aggregate is, are we apt to see a material decline in home prices as a result of this looming recession? Now, we see a lot of these other factors kind of in deceleration, which is in fact kind of a reinforcing mechanism on lower inflation overall, because you have essentially less demand, and then you have higher inventory, and you know that at some point prices are going to decelerate, and I do think that there is a reasonable risk nationally of home prices in outright decline. Now we did see again, not to kind of wax too nostalgic here, but in that red little comment there on this chart from Charlie Bolello, that home prices were down 26% from February 2007, which is the peak, down to the 2011 trough before they began their upward ascent. And then really over the last, call it 5 years or so, we've seen this dramatic spike in home prices. In fact, we've had quite a few all-time highs in a row. And so this level of change, or this slope, if you will, is unsustainable. And so I think this helps to reinforce the notion that, while I wouldn't expect, a cratering in home prices, I do think that there is the risk of, on a national basis, of having home prices come down. And we do know that regionally, in some areas of the country, that's already happening. Here's a quick look at fixed mortgage rates. Now, this week I just happened to pick the 15-year. We've looked at the 30-year fixed in the past, and we know that that one is well above 5%. The 15-year, those rates tend to be a little bit lower because, again, you have a time factor that typically influences interest rates and mortgage rates. Here we do see a little bit of gyration around the 5% level, but you can see basically the 15-year mortgage rate about 4.98%. A year ago, it was 2.1. Here's a chart from BKA research that I referred to earlier, and it's probably one of the most interesting things that I took a look at over the last week of doing research. And this is a relative analysis here of residential structure investment to population growth and number of households. And you see that both of these data sets are very highly correlated, but they tell a pretty telling picture here. Again, this data series goes back to 1960 or thereabouts. And so, if you look at a long period of time, and just as a frame of reference, anything less than 0 means that you're building less relative to population and household formation. So anything less than 0 represents the situation where you're under investing in residential structures relative to the population and household growth. And so that has absolutely been the case since the global financial crisis. And so when you hear me talk about how we've underinvested in residential real estate for a number of years, this is what I'm talking about right here. So if you go back decades before, these things oscillated around quite a bit, but generally speaking, they oscillated in a frequency level that you never really got out of whack. And but we did get carried away starting about the mid 90s or early 90s, and leading up to the global financial crisis. We just had too much inventory and too easy credit, and that whole market reversed itself. And so we went the other way for a couple of years, and then we've been underinvesting ever since. Even though we've been investing more, this is a big reason why we see home price appreciation of the order of magnitude that we have. Here's a quick chart on the market expectations for Fed funds rates looking out into essentially the next couple of years. So we're sitting here in August of 2022, Fed funds rates are about 2.3% right now. And, we are expecting more rate increases. I think, this is all of the, kind of the impetus behind market volatility over the last week or two following the Jackson Hole Symposium here recently. And so it really entrenched this notion that we're going to have a more aggressive Fed, that we should probably expect another 75 basis points of short-term interest rate increase, and then maybe 50 basis points or 0.5%, and then 25 after that, which would be 1/4%. And then ultimately you get up to something close to about 3.94% here. But then as that brings on a recession, then you would expect the Fed to respond the other way. And so this chart is telling you that in 2023, that there is likely to be, somewhere on the order of, on average, again, like maybe 1 or 2 rate decreases, and then maybe add on a third one by the end of, maybe by the end of that year, certainly into 2024, that you see that those rate expectations are going down consistently with this thought of recession. Now, that's not to say that the market is pricing in a recession for 2 years, because typically recessions have not been nearly that long. But you do see the expectation that, there's going to be a breaking point, about 4%, before which, or after which, I should say, the market is expecting these decreases to come into play. Here's our 5-year TIPS yield. So you look at this, and what this is telling you is that real rates are moving higher. And this is typically less conducive for appreciation of stocks and the stock market, but it is, I think, good from a long-term equilibrium standpoint. You don't want to see real rates stuck too negative, because that tends to bring froth into some markets. So I think this is a very healthy sign, real rates moving higher, and we'll continue to watch it. Here's a plot of the CPI index year over year to the Fed funds rate. And you can see in these areas where, we've had outsized CPI growth, that obviously the Federal Reserve acts in response to that. And you've seen this chart probably a gazillion times in different forms. But this goes back to 1970. So it gives us a time series that captures a lot of market downturns, a lot of recessions, and you can see that there's a pretty tight correlation when you get these CPI numbers above 5%. In other words, you get high inflation. It tends to overlay really nicely over with recessionary periods. And so, what this tells us is that the Fed is still behind the curve. And that they are increasing rates. We just saw that in the last slide, that we expect that to continue to happen through the end of this year in an effort to get up to a level closer to where inflation is now. At the same time, we expect inflation to actually come down. So there could be a meeting of those at some point, perhaps late this year, beginning of next year. But that those times where you see the CPI above 5%, that it tends to correlate pretty well with a recessionary period. Here's a quick look at CPI on the bottom in the red, overlaid against the Institute for Supply Management Manufacturing Index for prices paid. And so, obviously we've been talking about CPI, we've been talking about high inflation year over year, about 8.5% right now. But on the manufacturing sector prices paid, we do see that rolling over. I think this is a nice foreshadow, in a sense, of where we think inflation is going to go, because we see prices paid on the manufacturing side, again, with supply chain choke points kind of easing up a little bit. Obviously, we have less demand, so that is kind of cooling things off. And I think this is a really nice foreshadow, as I said, of where inflation is going to roll over here in the coming months. Here's a quick look at the US dollar, which we know is at its highest point since 2002. And we've had a tremendous increase in the dollar, and not too surprisingly, you've got a European central bank, which is, I mean, they literally just changed their policy rate to positive. They had a negative interest rate policy for quite some time, and obviously in the U.S. here, the Federal Reserve. I mean, we've been talking about positive rates for a long time, and so those types of differentials tend to influence the dollar, and so we're at a very high point. Typically not helpful as much for our exports, but we do know that we're in kind of a global slowdown, if you will. So this is clearly indicative of the U.S. being the best house in kind of a troubled global environment. Now we'll talk about some market volatility indicators, data that's compiled by Charlie Bolello, who does great work. I love these charts; they're very informative. So this is a chart of through the first 169 trading days of this year. We are sitting at a year-to-date return of negative 17.7% in the S&P 500. And this is a measure of volatility. So annual volatility for this year to date is 23.7. And you can see that that ranks number 11 all time in terms of annualized volatility. So the vol that we've been talking about, that we've been feeling, has actually been extreme. It's been real. It's been real. And you got to go back and look at these other years. Some years at the top here represent years in which we had positive volatility, where the market was up, especially in 1933, which we were coming out of this Great Depression before we eventually slipped back into recession a little bit later. So you see 1932, 1933, really high volatility, but positive performance tied to that. And then 1931 and then 34, around those 2 years, you had rather decent negative declines. And then '02, we know, was a very weak market before we established a new market cycle in 2003. But in any case here, we're down 17.7%, and we've had a lot of real volatility. And in fact, we've had the S&P 500. It was down more than 3% in one day. That has happened 7 times this year. And in the last 70 years, the only years where we've had more 3% down days has been 2008, 2009, and 2020. So this has been a dramatically, I'd say dramatically, this has been a fairly strong year for volatility. So this is a chart looking at worst performance in aggregate over the first 169 trading days. Last chart we looked at volatility. This is just raw performance, and so year to date we're down 17.7%, and that actually ranks number 4 all time. Fairly dramatic when you think about only 1974, 2002, and 1962 sitting at this juncture at the beginning of September that we have rarely been this negative. So, what we're seeing in terms of equity market performance is actually pretty rare. And of course, the big question marks here, what's going to happen between now and the end of the year? And well, how does that make the whole year look, from January to December? And we just don't know yet. And you can see that in most of these years where we've seen some pretty outsized negative performance numbers out of the stock market, that between now and the end of the year, we actually tend to see more positive performance, even though you still end the year negative. And that's the case where you see in the shaded green, with the exception of 1974, where we continued to slide. And that was kind of in the post-OPEC environment where we began to witness the early stages of stagflation and then hyperinflation. So different environment back then, but don't know where this market's going to go. If we're heading towards recession, there are opportunities, as I think we saw in July, for bear market rallies that then get tempered somewhat. Obviously, we're higher now than where we were at the end of June, but I mean, this could mean that we meander, but it certainly doesn't suggest that one should stay completely out of the market or liquidate. That there are decent chances for us to be a little bit higher at the end of the year. And here's a chart looking at the kind of the traditional growth portfolio. We call it 60% stocks, 40% fixed income. We know the first half of this year through the end of June that the total return for that portfolio was down around negative 16%. Now, equity market has improved a little bit. Fixed income market really has remained somewhat stagnant. And so that total return now through the end of August is negative 13.9%. Again, it's exceptionally rare that you see that. And honestly, there's a fairly strong contribution to that negative 13.9 from fixed income. And that is the most awkward piece of all of this, because that's traditionally not the case. And you see in these other years, 2002 to 2008, so on and so forth, that, I mean, you have year to date, negative returns for a traditional growth portfolio. But in most of these other years, that negative total return year to date number for that growth portfolio has been driven by the equity side. You tended to have some offsets from fixed income, i.e. that in some cases that these negative total return numbers were actually more negative from a stock standpoint, but you got a benefit from owning bonds in that 40%. But that hasn't really been the case this year. That's really odd. And so, but it is worth noting that this environment this year, this negative 13.9% for the traditional growth portfolio, as defined by 60% allocation to the S&P 500 and 40% allocation to the Bloomberg U.S. Aggregate Bond Index, it is just a very unusual year. A quick look at economic growth defined by U.S. real GDP, and looking at consecutive quarters of negative growth here. And so in the middle columns, you see the time frames that we're talking about here. And obviously we've had two negative quarters of GDP growth. First quarter of this year was driven more by trade. And then the second quarter is really driven more by demand and inventory. So two different reasons, but nevertheless they were negative, represented two consecutive quarters of negative economic growth. So we don't know whether we're in a recession right now. I think over the last several months there's been probably a groundswell of data, particularly related to income and labor, that would suggest that maybe we were not in recession. However, I think with demand beginning to slide, we're beginning to see some of the typical trappings of what you might expect in a recessionary environment. We may not be quite there yet, and we won't know generally until after we're in it, but there is strong predictive power in this number of two consecutive negative quarters of growth. That as you can see here very well, that would tend to suggest that it's going to happen if it's not already in process. The only exception was back in 1947, where we had two negative quarters of growth, and that was in the years after World War II, where there was a lot of productive displacement and re-engineering of production plants, that moving away from the developing and manufacturing war material to going back and manufacturing cars and stoves and vacuum cleaners and whatnot. So a different period back then, but in most of these other cases where you've had the consecutive negative growth, it has represented or correlated to a recession. So something else I've been tracking has been gasoline prices and different parts of the energy market. Obviously, gasoline prices at the pump has been one of those purest ways that people can measure their own personal inflation rate. And you can see that these the two dotted lines on the chart on the left that represents gasoline demand, and the current year represents the blue. And you can see where that blue line as of March fell below the year ago level. So what we see here is that gap is widening out. So demand for gasoline is clearly dropping off, and it's not just a seasonal pattern. It's really indicative of core demand for gasoline dropping off. At the same time, you see over here on the right-hand side that gasoline priced in the futures market on NYMEX is actually continuing to go down. So that would correlate pretty well with a drop in overall demand, and I think these two charts tie together really nicely to kind of paint that picture that production issues aside and refining capacity issues aside, it would tend to suggest that that we'll likely continue to see some degradation in energy prices. Now, we've got a few slides left, and I just wanted to kind of highlight the monthly factors in the equity market, which I thought were kind of interesting. So these are factor returns for the month of August in the equity market. You can see low volatility was still negative. Obviously, the market was negative for the month, but it was more negative if you were in high beta or growth. And particularly small caps, which we've de-emphasized, but the other factors which tend to perform better, even though they were still negative, were dividend growth and quality. High quality didn't perform as well as I perhaps thought it would, but certainly dividend growth performed exceptionally strong. Here's a look at the credit market and how credit has performed over the last month. And what's really interesting is you've got the 7 to 10-year Treasury, which is a IEF exchange traded fund here, serving as that proxy, and that was down around 3.8% for the month. And you can see the areas of the market that performed relatively well: leveraged loans, business development companies. Emerging markets, actually on a relative basis, even though they were negative for the month, performed better, and municipal bonds. And then you can see here going down the list. What's really interesting is that investment grade corporates perform the worst out of all of these categories, even worse than high yield corporate bonds, which is rather interesting, and it kind of represents more of what I think is a supply and demand kind of issue. People worried about credit spreads beginning to blow out a little bit, and then getting out of some of the areas that might be most leveraged to that credit spread. And we talked about freight earlier, and here's another representation of that. The Baltic Dry Index is a very widely cited and used and analyzed index for global trade and global shipping. And you can see that we have gotten back down to levels that we haven't seen for a couple of years, and we're getting close to pre-pandemic levels. But I'd say that we're now back at a point where it meets the trend line over the last decade. That's all we have for today. Hope you've enjoyed the chart pack. Have a great week. Happy Labor Day. We'll talk to you again soon. Take care. Bye.